I think as a DCM banker in the market, my job is actually to create transactions and bring multi-currency deals into this market. What I've seen from this development of the interest yield curve here, as you said, dollars is on the path to do this interest rate cut, while at the same time, the convergence of the rates, the differential between the rates between different central banks and U.S. will be more and more clear into next year as the gap between this yield differential will narrow significantly, especially when the U.S. Fed, they cut rates maybe at a higher pace than the Central Bank of China. That will actually closer the gap between these two central government yield curves. And I think that will create more opportunities for these bond markets. And we might see some comebacks of the dollar transactions from Greater China regions into this market, which has been decreasing significantly for the past 3 to 4 years. We had a outstanding volume of China DCM at roughly $1 trillion at peak in 2021. Now this figure has dropped significantly to more than $600 billion in the market. So the Greater China investors have a lot of reinvestment risk for them with this shortage of this $400 billion. So that's a trend I think we could watch for next year.
Right.
And in the meanwhile, because of the stability of the currency of the Chinese yuan and also the resilience of the economy that China has demonstrated, during this, the tariff situations this year especially, I think the yuan markets will also be booming because the demand will not only come from the domestic issuers and investors, but also we see the diversifications from outside of China. For example, this year in the dim sum bond market, which is the offshore bond markets of Chinese yuan, we have seen a significant increase of international issuers worldwide from the Singapore, from the government of Indonesia, from Europe, like OTPP Bank, from Central Asia, like the Development Bank of Kazakhstan, the Kazmunoy Gas from Kazakhstan. All these diversified issuers came to Hong Kong to tap the dim sum bond market. I think it's a very interesting case to establish here. And also, if you look at some deals that happened this year in Hong Kong, one interesting deal is with the China MOF US dollar deal.
Okay.
That we actually lead the underwritings of that deal.
That was the offshore deal, right?
That was the offshore deal.
Do we get more of that? More sovereign issuance next year in dollars?
I think China MOF priced a $2 billion USD bond in the market for 3 years.
Okay.
And then if you look at the credit spreads to US dollars, it's actually zero. So the deal was priced at Treasury plus 0 credit spreads for the 3 year and Treasury plus 1 basis point for the 5 year.
Okay.
Tranche with a total deal size of $4 billion across 2 tranches. If you look at the stats, even at a zero spread, we attracted more than 40% of investors from central banks worldwide. And guess what happened in the secondary markets? The bond was traded below the Treasury in the negative 20 basis points, something like that.
Okay.
Some argue that was driven by the tax shield from the Greater China investors. But this links to another story from the Greater China investor side. As you know, the current interest rates environment was still China has a very low interest rates environment. So currently the 10-year CGB bonds in China is only like 1.8%, while the U.S. 10-year Treasury is like 4.1%. So this gap between these two rates actually creates a lot of demand from Greater China investors to diversify the investments in the offshore markets.
Okay, we've opened up a lot of doors. That's a lot of information. So one thing that stood out to me is, you could shed a lot of light on this, is across these multiple fronts, where does supply look to be the most active in the first quarter of next year? Which specific market, which specific currency under your specific watch?
I think within APEC markets, given, China has always been a very big player, which, accounts for, roughly 50% of the supplies.
Okay.
So I believe the trend will continue into next year, but you will see more and more issuers in the dollar space, but may not in the plain vanilla bonds, but also probably the convertible bonds, increasing the supply in the convertible bonds, given the upside of the equity stories, as well as the relatively high, yield in dollar will still sustain in the next year. And then we'll see a diversified supply actually for the dim sum bond markets, maybe from regions from Southeast Asia, from Middle East, from Central Asia. I think the logic behind for people to seeking for diversification is actually not only to get a cheaper funding source from the diversification into renminbi, but also to get a sustainable new currency market to borrow. For example, in the case of the government of Indonesia...
How deep is the investment pool? Just to ask you on that. Because they're tapping a new investor base, to your point, right?
Yes.
So how deep can that market get in terms of liquidity?
Yeah, that's a very good question, David. I think speaking of the dim sum market, it's still a growing market, and it's still at a infant or a baby stage as compared to dollars or euros or the, hard currencies markets.
Right.
But we have seen some really trend on the diversifications not only come from the international investors who has gaining momentum in playing in the renminbi bond products, but also the keenness of the domestic investors who are keen to deploy their capital from onshore to offshore. I'm not sure if you heard about the mechanism we call Southbound Connect scheme, which is basically the infrastructure that links the China market with the Hong Kong market via the CMU mechanism. And the onshore investors can therefore invest in the offshore bond markets, primarily in the CNH products through this mechanism directly without any transaction cost. And we believe this pool of investments will further deepen next year. And this year, we're already seeing like 700 billion to 800 billion renminbi worth of capitals coming to Hong Kong to support the markets.
One more interesting that I hope you could talk about this is interesting for global viewers. The dichotomy between onshore rates where, let's just call it they're very, very low, and the preference is certainly lower borrowing costs, against somewhat higher yield here in Hong Kong, but higher yield, of course, when you look at the U.S. What conversations are you having with your client in terms of, if a client is able to access both markets, what is the current preference, right, in terms of fundraising, and why? Offshore or onshore?
Yeah, I think my clients has two universe, right? One is those clients who are based in China. They're doing this cross-border bond raising or financings for their companies to expand either overseas, or they want to bring the money back to China for investments. And the other universe of my client base is actually international clients, like our Hong Kong clients, like our Southeast Asian clients, who are looking for diversifications. So I would say the behaviors tend to be very different. For the China clients that I can see, because of the lower rates environments in domestic markets, a lot of clients actually chose to refrain from doing US dollar financings anymore. They go back to the home markets and raise more bonds issuance in the domestic markets, because central bank has keeping this, loose monetary policies to keep the ample liquidity in the domestic markets, which provide a very lower funding cost and extension of maturity profiles for the domestic borrowers. However, for some of the borrowers who have international needs to diversify, or they have been offshore projects to invest and expand globally, they will still choose to come to the international markets to either issue a dollar bond or issue a dim sum bond, the renminbi bond, in the offshore markets, and invest those proceeds into their overseas projects.